Even when the market continues to rise, Warren Buffett does not stop selling his shares and accumulating cash like never before in history. This is not caution, it is a signal. He has done this before 2000, before 2008, and now again. But what does he know? And what could be costly for those who do not see it in time? Today we will reveal what is behind this decision of his, the hidden risk behind this euphoria in the market, and what you can do now, even with a modest portfolio. Warren Buffett has spent the last 2 years doing something that many consider unthinkable in a booming market. He has sold shares for 9 consecutive quarters, and more than that, his company, Berkshire Hathaway, now holds over 56% of its portfolio in cash. That amounts to more than 347 billion euros sitting idle, waiting for something. And the figures that explain this, you will see now, and they will surprise you. This move is anything but common. Buffett is known for holding on to stocks for decades. When he decides to divest from positions such as Apple or Bank of America, it is nothing more than a symbolic gesture. It is a signal we have seen before. In 1999, while the world celebrated dot-com companies, he was liquid. In 2007, with banks inflating credit, he was once again holding billions. In both cases, the bubble burst shortly after. The pattern is repeating itself now, and the inevitable question arises: is he seeing something that the rest of the market has yet to perceive? In 2008, when the global financial crisis reached its peak, Buffett used precisely this cash reserve to make historic moves. He bought stakes in solid companies that were in free fall. While the majority were selling in panic, he was buying with a margin of safety, and he profited billions. Today, once again, he waits. In a scenario where indices are hitting record highs and confidence seems blind, Buffett positions himself as someone who prefers to lose a bullish wave rather than be caught in a downturn. He himself stated, "In euphoric markets, the best investment may be to do nothing. But could you remain still while everything around you rises? In the meantime, consider that this money is not idle. With American interest rates around 5%, the yield from reserves and treasury bonds alone generates approximately 16 billion euro per year, without volatility, without the risk of drawdown. Just well-rewarded patience. The logic is simple. If prices are too high, future returns will by definition be lower. But how can one know if we are really in an expensive market? What are the objective signals that we are paying too much for common assets? If there is an objective way to know when the market is excessively optimistic, Buffett has made it clear which metric to observe: the ratio between the total value of stocks and the country's gross domestic product. This is known as the Buffett indicator. Currently, it stands above 200%. This means that investors are paying double the value of the actual economy to own stocks, a figure that on its own should raise alarms. For comparison, at the peak of the dot-com bubble in 2000, this indicator was at 155%. Today, we have comfortably surpassed that level. Why should this concern you? Because for Buffett, a company's value is directly linked to its ability to generate cash in the future, and not to speculations about infinite growth. When market value disconnects from the real production of the economy, there is a concrete chance that future returns will be disappointing. Another concerning statistic is the CAPE, a 10-year inflation-adjusted average of earnings. A high value may indicate that the asset is expensive in relation to its historical earnings, while a low CAPE might suggest that the asset is undervalued. The current value is 38.35. Historically, the average hovers around 17.74. We are 116% above the average, a level that has only been seen prior to significant corrections. Have profits really grown that much to justify these prices? Or are we simply paying too much for each euro of profit? Let's simplify this. Imagine a friend presents you with an investment that pays 10,000 euro a year. Would you pay 1 million euro for it? Probably not. That would be a return of only 1% per year. And that is what many are unknowingly doing in the market today. That is why Buffett avoids companies he cannot clearly value. Businesses without a history of consistent profits, or whose models are difficult to understand, he simply ignores. This is where many get confused. Just because a stock goes up does not mean it is good, nor does it mean it is cheap just because it has fallen. The real criterion is intrinsic value, and whether the current price provides a margin of safety. But how to turn all this into action? Now comes the most important part: how to apply this, even with little money, in a practical and protected manner. Warren Buffett often says that investing is like batting in baseball, but with one advantage: you are not eliminated for waiting for the right pitch. You can observe as many balls as you wish without the slightest pressure to act. The investment decision only needs to be made when the conditions truly make sense. But how many investors today have that patience? Most try to anticipate the market. They chase trends. They buy what is rising, sell what has fallen. And in this process, they make more mistakes than correct decisions. Buffett does the opposite. He observes, and when the right opportunity appears, he acts with conviction. Few decisions throughout his life, but deeply rational ones. Part of this strategy involves what he calls the stack of hard decisions. Any company that he cannot understand or whose future profits are unpredictable, he ignores. It does not matter the hype. If he cannot confidently estimate how much that company will generate in cash over the next 10 or 20 years, he moves on. This philosophy of waiting also applies to market cycles. Buffett and Charlie Munger have always defended the idea of being ready, but without acting out of anxiety. In times of excess or panic, the best move may be to stand still. And this is proven by the data. A study by Credit Suisse shows that over the last 20 years, the 10 best days in the American stock market accounted for more than 60% of the total returns. And the most interesting part, many of those days came immediately after significant declines. This means that those who try to exit and return miss the most profitable moments. You do not need to time the market perfectly. You simply need to be positioned when it recovers. But how do you maintain that discipline when everything around you seems to suggest it is time to act? Imagine you only have €1,000 to invest. Do these principles still apply? Yes. And this is where everything changes. Buffett can remain liquid for years because he manages hundreds of billions and requires opportunities that move the needle of one of the largest companies in the world. However, for you, the individual investor, the reality is different. You do not need and should not wait for the perfect opportunity. What you need is consistency. And consistency means investing with discipline, even when the market appears uncertain. The best strategy for this has been known for decades and works particularly well in volatile markets. Making regular contributions every month, regardless of what the market is doing, is how wealth is built with risk control and predictability. During the coronavirus crisis in 2020, while many sold in panic, those who maintained their regular contributions saw an accumulated return of over 80% by 2024. This is because the market rewards those who stay, not those who try to predict the next move. You may end up paying high prices in some months, but you will also buy low in others, and in the end, your average cost tends to reflect the real value of the assets. This is the beauty of the method. It works because it removes emotion from the equation. Now, perhaps you are thinking, what if I want to go beyond the basics? Is there a way to seek higher returns without needing to behave like Berkshire? There is, and it involves a type of investment that Buffett would love to explore if he had less money to manage. Let's talk about that now. Berkshire Hathaway does not invest in small companies, not because they are bad, but because with hundreds of billions under management, these assets simply do not make a difference. Buying a good company with €500 million market value does not make a difference in a portfolio of €350 billion. Buffett is like a transatlantic ship. He cannot turn quickly, but you are a jet ski. You can change direction in seconds, and that is where your biggest advantage lies. As an individual investor, your advantage is precisely where large funds cannot operate, in the realm of small caps. Smaller companies often neglected by the market, with less analyst coverage and a greater chance of being undervalued. This is the field of real asymmetry, where you can find value before it is perceived. Buffett has said that if he had only $1 million to invest, he could achieve returns of 50% per year by exploring this universe. And this is not an exaggeration. The difference is that he cannot operate at this level today. But you can. The question is, how can you identify these opportunities? A practical approach is to apply simple yet effective filters. Companies with a price-to-earnings (PE) ratio below 10, price-to-book (PB) ratio less than 1, and return on equity (ROE) above 15% already indicate a rare combination of value and efficiency. It is within this range that many small caps with solid fundamentals reside, yet still outside the radar of large investors. Now, of course, you may be wondering, how can you balance these more specific bets with a solid portfolio base? There is an intelligent hierarchy of allocation that can help you do this without compromising safety. And understanding the hierarchy of allocation is just as important as choosing good assets. This hierarchy starts with a foundation that many ignore, the emergency fund. Without it, any personal unforeseen event, a dismissal, an accident, an unexpected expense, can force you to sell good investments at the worst possible time. Even those who already have this fund can use it as strategic cash, ready to be allocated when rare market opportunities arise. The second pillar is asset protection outside the traditional financial system. Having a small part of the portfolio in physical gold or Bitcoin can serve as insurance against monetary crises, inflation, or dysfunctions of the fiduciary system. It is a way to preserve value when the rest seems to be melting away. The third step is diversification. Different sectors react differently to each crisis. While one sinks, another may thrive. The same applies to countries. Having assets spread across developed and emerging economies reduces risks and increases the stability of the portfolio in the long run. Finally, there is one asset that can never be overlooked: yourself. Investing in knowledge, study, and critical thinking is what transforms strategies into real results. Without this, everything else loses consistency. It is no coincidence that Buffett reads every day, but if you could take just one message from this video, it would be this. Understand that Warren Buffett does not shout. But when he accumulates cash and reduces stocks, the message is clear. Protect your wealth. And you have seen what this signal represents and how to apply it to your reality. Remember, patience always rewards those who act logically. And the best time to prepare is before the storm. If you value this kind of valuable and direct content, like the video, subscribe to the channel. We will see you in the next video.